Welcome back to We Are Cosmic, everyone. If you are new here, welcome to the channel where we talk about finance, crypto, and the future of money in a calm, honest, and realistic way. No hype, no fear, just real analysis, real information, and real long-term thinking. If you are someone who wants to understand what is actually happening behind the scenes in the financial system, you are in the right place. Now, let me start with a simple but powerful question. What if the next major move in crypto does not start with Bitcoin headlines, ETF hype, or social media noise, but instead starts quietly in Japan? What if a decision made by the Bank of Japan ends up shaking global markets and indirectly creates massive volatility across stocks, bonds, and even crypto assets like XRP? That is exactly what we need to talk about today. Over the last few days, a respected macro voice, Jake Claver, has been saying something very interesting. According to him, we may already be at the point where markets are extremely sensitive, and a single trigger, like a rate hike in Japan, could cause a sharp move. He specifically mentioned that if Japan raises rates aggressively, we could see a rapid unwinding of the famous yen carry trade, and that could lead to a happy Monday for markets. Maybe Friday, maybe Monday. But the timing, according to him, is very close. Now, before anyone gets emotional or overly excited, let's slow this down and understand what this actually means. Because here on We Are Cosmic, we don't just repeat opinions, we break them down. For decades, Japan has kept interest rates near zero. This allowed global investors to borrow cheap yen and invest that money into risk assets like stocks, bonds, and yes, crypto. This strategy is known as the carry trade. It worked because borrowing costs stayed low. But once Japan starts raising rates, that trade becomes expensive. And when it becomes expensive, positions start closing. When positions close, liquidity moves fast. And when liquidity moves fast, markets don't move gently, they move violently. Jake's point is simple but important. A small rate hike, like 25 basis points, may cause only a small reaction. But if Japan moves 50 or even 75 basis points, something that has not happened in decades, the unwind could be aggressive. That is when things can get interesting and also dangerous across global markets. So the real question becomes this. What does any of this have to do with XRP? Honestly? Directly? Not much? Indirectly? Potentially a lot. XRP has always been positioned as a liquidity asset. It exists for moments when the traditional system struggles, moments of friction, inefficiency, and stress. If global markets experience liquidity shocks, capital looks for systems that move fast, settle instantly, and operate 24/7. That is where assets like XRP enter the conversation. Not as hype, not as speculation, but as infrastructure, and this is where things start connecting. Ripple is not just a token company, it is quietly building a full financial stack. Liquidity, custody, settlement, stablecoins, institutional rails, and now regulated pathways for banks and corporations. When people talk about Ripple becoming a juggernaut, this is what they mean. Not price tomorrow, not candles, but relevance in a changing system. Now let me be very clear. None of this guarantees price action. Anyone promising guaranteed explosions is not being honest. But what can happen is this. When the current system shows cracks, alternative systems start getting attention. That attention does not come from retail first, it comes from institutions. And today's video is about understanding those signals early. So in this breakdown, we are going to calmly walk through what Japan's rate decision means, how liquidity cycles actually work, why XRP keeps appearing in these macro conversations, and how regulation, tokenization, and institutional adoption are quietly aligning in the background. For decades, Japan has been a unique player in the global system. While the US and Europe raised and cut rates in cycles, Japan stayed near zero. This created one of the biggest financial strategies in modern history, the yen carry trade. Investors borrowed yen cheaply and deployed that capital into higher yielding assets around the world. Stocks, bonds, real estate, emerging markets, and eventually crypto all benefited from this hidden source of leverage. The key thing to understand is this: the carry trade does not disappear slowly. It unwinds quickly when conditions change. When the Bank of Japan raises rates, borrowing yen becomes more expensive. That forces large funds to reduce exposure. They sell assets to repay yen loans. This selling does not happen in one market only. It happens everywhere. That is why a decision made in Tokyo can impact Wall Street, Europe, and crypto markets within hours. Now, according to current probabilities, there is an extremely high chance that Japan raises rates aggressively, possibly 50 or even 75 basis points. That would be the highest move in decades. If that happens, we are not talking about normal volatility. We are talking about forced repositioning. This is what Jake Claver is referring to when he says reverse carry trade. It means money flows back into yen, liquidity pulls out of risk assets, and markets react sharply. Sometimes that reaction is negative first, a shock, followed by a reallocation into systems that can handle stress better. And this is where the story gets interesting for crypto. Crypto markets are not isolated anymore. They are connected to macro liquidity like never before. Bitcoin behaves like a liquidity sponge. Ethereum powers infrastructure. And XRP sits in a very specific lane, payments, settlement, and cross-border liquidity. During liquidity stress, institutions do not ask, which asset pumps the hardest? They ask, which system still works when everything else slows down? Traditional banking relies on Nostro and Vostro accounts. That means trillions of dollars sit idle across the world just waiting to be used. That capital earns nothing. It is trapped. And during market stress, trapped capital becomes a liability. Now imagine an alternative system where money can move instantly 24/7 across borders and even earn yield until the moment it is needed. That is not a fantasy anymore. That is exactly what blockchain-based settlement enables. This is why XRP keeps showing up in these conversations. Not because of hype, but because of functionality. Does a Japanese rate hike automatically pump XRP? No. Anyone telling you that is oversimplifying. But what it can do is expose the weaknesses of the current system. And when weaknesses are exposed, solutions gain attention. We also need to understand something very important. Big moves often happen over weekends. Liquidity is thinner. Markets are less prepared. That is why Jake mentioned the idea of a happy Monday. It is not about predicting a date. It is about understanding market structure. Now, let me set expectations properly. Liquidity shocks can be messy. They can cause sudden drops before any upside appears. This is why emotional trading destroys people. Institutions prepare for volatility. Retail reacts to it. Here on We Are Cosmic, the goal is not to predict candles. The goal is to recognize structural shifts early. Japan tightening policy is not a small headline. It is a signal that the old era of free leverage is ending. When free leverage ends, efficiency matters, speed matters, settlement matters. It is quietly positioning itself as a full-stack financial infrastructure provider for institutions, banks, and large corporations. This is where the XRP conversation shifts from speculation to strategy. One of the biggest developments that often gets overlooked is Hidden Road. Hidden Road is not built for retail traders. It serves hedge funds, market makers, and institutions that need deep liquidity, prime brokerage services, and efficient settlement. When Ripple acquired Hidden Road and then rebranded its institutional offering into what is now known as Ripple Prime, that was a very deliberate move. Why does this matter? Because prime brokerage is where real volume lives. This is where trillions of dollars move every year. And historically, crypto has struggled to plug into this world due to regulation, custody concerns, and settlement risk. Ripple is solving those problems step by step. Ripple Prime gives institutions access to liquidity, custody, financing, and settlement under one umbrella. When you combine that with XRP's role as a bridge asset, you are no longer talking about a token. You are talking about a settlement layer for institutional capital. Another critical point is scale. There has been mention of roughly $12.5 trillion per year moving through systems connected to large corporate clients that Ripple already works with. These are not experiments. These are real businesses with real cash flows. When those clients gain the ability to move funds instantly and globally, the competitive advantage is massive. Think about it this way. Today, corporations must pre-fund accounts around the world. That money sits idle. It earns nothing. It is trapped capital. This system exists because payments are slow, fragmented, and risky. Now imagine replacing that with a system where funds can stay productive until the exact second they are needed, and then move instantly across borders. Even earning 1% yield on trillions of dollars is not a small improvement. It is transformational. At 2% or 3%, it becomes impossible to ignore. This is why institutions do not walk toward this technology. They run once regulation allows it, and that brings us to regulation. For years, the biggest blocker for institutional crypto adoption was uncertainty. No bank wants to build on rails that could be declared illegal later. That is why Ripple's strategy has always been regulation first. Not popular, not exciting, but effective. Now we are entering a new phase. Stablecoin rules are starting to form. The Genius Act has laid groundwork. The upcoming Clarity Act is expected to define how digital assets fit into the financial system in the U.S. Once these rules are in place, institutions can finally move forward without fear of legal backlash. This is also where XRP's supply dynamics come into focus. A lot of XRP liquidity already exists in escrow. Ripple controls when and how that liquidity enters the market. If institutional demand increases and OTC desks start drying up, pressure builds. And unlike retail markets, institutions do not chase price. They secure supply before it becomes scarce. There are only two places to source large amounts of XRP at scale: exchanges and Ripple itself. And Ripple does not have to sell if it does not want to. That creates a very unique dynamic when demand increases. Right now, the conversation around XRP ETFs is quietly heating up. WisdomTree has an XRP ETF application under review, and this is not a small player. WisdomTree manages over $100 billion in assets. Compared to other applicants like CoinShares or 21 Shares, WisdomTree is operating on a completely different scale. This matters because large asset managers do not file these products casually. They spend years studying demand, regulatory signals, and future positioning. The SEC has a limited window, around 240 days, to respond to these applications. That process is not about whether XRP is popular on social media. It is about whether XRP fits into a regulated investment framework. Now, let's be very clear. Approval is not guaranteed. Timelines shift, conditions change, but the fact that these filings exist at all tells us something important. Institutions are preparing for a future where XRP is investable at scale. And this is where people often miss the bigger picture. The real significance of an ETF is not day one inflows. It is what happens after approval. Pension funds, endowments, family offices, and large allocators cannot buy assets directly on exchanges. They need regulated wrappers. ETFs provide that wrapper. This is also why names like BlackRock and Fidelity matter, even if they are not filing yet. BlackRock does not chase trends. It builds exposure decades ahead of time. Larry Fink has been very open about tokenization, digital assets, and the future of capital markets. To assume that BlackRock is not planning for XRP and similar assets is to misunderstand how these firms operate. They do not wait for retail demand. They anticipate it. Another important point is daily accumulation. There are reports of tens of millions of dollars of XRP being bought consistently through OTC channels. This type of buying does not seek attention. It seeks efficiency. And it does not continue forever. At some point, liquidity tightens. When OTC desks cannot source enough XRP without moving price, buyers have two choices: stop buying or move to public markets. That is when price discovery changes. And again, Ripple plays a unique role here because of escrow control. Now let's connect this back to regulation. For years, the SEC's hostile posture made institutional adoption impossible. Banks did not want lawsuits. Asset managers did not want uncertainty. That era appears to be ending. With more crypto-friendly regulators and clearer frameworks emerging, the doors are slowly opening. This does not mean everything goes live overnight. Rulemaking takes time, infrastructure takes time, education takes time. But once a system is approved, adoption accelerates faster than most people expect. And this is why patience matters. Most retail investors focus on price candles. Institutions focus on plumbing. ETFs, custody, liquidity, compliance. These are the boring things that build trillion-dollar markets. Tokenization is the process of taking real-world assets, stocks, bonds, treasury funds, real estate, even art, and converting them into digital tokens that live on a blockchain. Why does this matter? Because the current system is inefficient. Every trade involves multiple intermediaries, multiple ledgers, and multiple reconciliation steps. It works, but it is slow, costly, and capital intensive. Tokenization fixes that. Companies like Securitize are leading this change. They are bringing traditional assets onto blockchain rails and showing Wall Street that you can have speed, transparency, and security all at once. This is not a small market. Tokenization has the potential to handle trillions of dollars in assets. And when you combine tokenization with platforms like Ripple that enable instant settlement, the system becomes exponentially more efficient. Take public equities as an example. Today, when a company trades its stock, the process can take days to settle. With tokenization and blockchain, trades can settle instantly, and ownership is cryptographically secured. Dividends, corporate actions, and transfers can all be automated. That is the power of tokenized assets: efficiency, speed, and transparency. But tokenization is not limited to stocks. Treasury funds, corporate bonds, and even stablecoins are already being tokenized. These are the largest and most liquid assets in the world. By starting with high-volume markets, tokenization ensures that infrastructure gains adoption quickly. Once these systems are proven with large liquid markets, they can expand into other areas like real estate, artwork, collectibles, and more niche markets. This is also where institutional strategy becomes clear. Investors and corporations do not invest in tokenized assets for excitement. They invest for efficiency, yield, and control. By moving assets on-chain, capital becomes productive. Previously idle funds now earn yield until they are needed. Processes that used to take hours or days now take seconds. And the system can handle extreme stress scenarios that legacy infrastructure struggles with. Wall Street is starting to notice. Firms like Apollo, JP Morgan, and other financial powerhouses are experimenting with tokenized assets, either by creating their own solutions or partnering with specialized companies. This is happening quietly, away from headlines and retail hype, but it is real, strategic, and potentially game-changing. The regulatory environment is crucial here. In the past, uncertainty around SEC enforcement and digital asset legality held institutions back. Now, with clearer rules and no action letters from regulators, firms have the confidence to start integrating tokenization into their operations. Once rules are fully established, adoption is expected to accelerate rapidly. Early movers will have a significant advantage. And this brings us back to XRP and Ripple. Ripple's infrastructure is positioned to support tokenized liquidity at scale. Think of it like the plumbing for a building. You can have all the assets in the world, but if the plumbing is inefficient, nothing flows properly. Ripple and XRP are building the plumbing layer for this new tokenized economy. In short, tokenization is not a small experiment. It is the foundation of the next generation financial system. The first assets to move on-chain will be the biggest, most liquid ones. Over time, as the system proves itself, less liquid or niche assets will follow. This is why adoption curves are likely to be exponential once institutional confidence hits critical mass. We started with Japan. The Bank of Japan's potential rate hike and the unwinding of the yen carry trade are immediate triggers that can shift liquidity across global markets. These events are important because they show how fragile and interconnected financial systems are. Institutions are watching these moves carefully, not for short-term speculation, but to adjust strategies, rebalance capital, and secure access to liquidity in a changing environment. This is exactly where Ripple and XRP fit into the puzzle. XRP is not just a token for trading, it is a bridge asset designed for instant settlement and global liquidity. Ripple's ecosystem, including Hidden Road and Ripple Prime, provides institutions the tools to move large sums of money efficiently, securely, and with transparency. Unlike traditional banking, where capital is trapped and earns nothing, Ripple's system allows funds to remain productive until they are needed. That efficiency is becoming more valuable as global liquidity events increase in frequency and scale. Next, we looked at ETFs and institutional adoption. Products like WisdomTree's XRP ETF, CoinShares, and even the anticipated involvement of giants like BlackRock and Fidelity signal that institutions are preparing for mainstream crypto integration. ETFs are not about hype. They are about regulated, scalable access. Once approval happens, large funds, pension plans, and endowments will be able to participate directly, increasing demand for XRP in a measured, sustainable way. Then we explored tokenization, the next frontier. Tokenization is quietly transforming the financial system by moving assets on-chain, treasuries, corporate bonds, stablecoins, and eventually public equities. This is where blockchain proves its real-world utility. By reducing intermediaries, enabling atomic settlement, and improving transparency, tokenization makes markets more efficient. Institutions see this as an opportunity to modernize operations, earn yield on previously idle capital, and reduce risk. Ripple's infrastructure is strategically positioned to serve this tokenized economy, acting as the plumbing for all these new assets. When we combine all these elements, macro liquidity events, Ripple's infrastructure, ETF developments, tokenization, and regulatory clarity, a clear narrative emerges. The financial world is moving towards systems that are faster, more efficient, and 24/7. XRP sits at the intersection of these changes, not as a speculative play, but as a functional solution. It has the network, liquidity, regulatory positioning, and institutional adoption necessary to be a critical component in the next generation financial system. Now, let's be honest, this is not an overnight transformation. There will be volatility, there will be setbacks, regulatory timelines may shift, ETF approvals may take months, market psychology will continue to react to headlines, but the structural trends are undeniable. The world is moving from slow, siloed, and inefficient systems to fast, interconnected, and productive financial rails, and XRP is already positioned in that lane. As an investor, analyst, or enthusiast, it's important to focus on these fundamentals rather than daily price swings. Liquidity, adoption, regulation, and infrastructure matter far more than hype or social media predictions. Understanding these elements gives you the clarity to see where the real value is being built. So what's the takeaway? Japan's liquidity moves, Ripple's ecosystem, institutional ETFs, tokenization, and regulatory clarity are all part of the same evolving story. XRP is not just a token, it is a solution designed for a financial world that is moving faster and becoming more interconnected every day. Patience, understanding, and strategic awareness are key to navigating this evolving landscape. That wraps up our deep dive into the macro XRP, Ripple infrastructure, and tokenization. If you found value in this breakdown, please hit like, leave a comment, and subscribe to We Are Cosmic. Sharing this knowledge helps more people understand the financial systems shaping their future. Stay calm, stay informed, and we'll continue exploring the exciting world of crypto together.